Hello everyone. Before we move into the most important units of this course, I want to take one full session to build a common language. In international financial management, a lot of confusion arises not because of the concepts are difficult, but because students are not comfortable with the basic terminologies. So today we are going to slow down deliberately. Take each term one by one, understand it clearly, and work through simple numerical illustrations to understand the basic terminologies and concepts of international financial management. Let us begin. We will first discuss the spot rate and the forward rate. The spot rate is the exchange rate at which one currency can be exchanged for another currency immediately, that is for delivery and settlement within 2 business cycles. When you walk into a bank or a money changer today and ask, what is the rate of the dollar? The rate they quote you is essentially the spot rate. It is the current prevailing market price or government fixed rate of one currency expressed in terms of another. We express an exchange rate as the price of one unit of foreign currency in terms of the domestic currency. In India, we would say spot rate is 1 USD is equal to 83.50 rupees. This means that right now, today, if you want to buy 1 US dollar, you must pay 83.50 rupees. Alternatively, if you are selling 1 US dollar, you will receive 83.50 rupees. The spot rate changes continuously throughout the trading day because it is determined by demand and supply in the foreign exchange market. The forward rate is the exchange rate agreed upon today for the transaction that will take place at a specified future date, typically 30 days, 60 days, 90 days or 180 days from now. No money changes hands today. What happens today is only the agreement. That is, the contract is signed. The rate is fixed or locked in, and the actual exchange of currencies happens on the future date at the pre-agreed rate. Let us take an example. Suppose an Indian exporter has sold machinery to US buyer for USD 5 lakh. Payment will be received in 90 days. The exporter is worried that in 90 days the rupees might strengthen, making each dollar will fetch fewer rupees than today. To protect himself, he enters into a forward contract with his bank today. The bank agrees to buy his USD 5 lakh at a rate of Indian rupee 84.20 per dollar, that is 90 days from now. So, spot rate today is 1 USD is equal to 83.50 rupees. 90-day forward rate agreed today is 1 USD is equal to 84.20 rupees. Now, regardless of what the spot rate will be on the 90th day, that is after 90 days, whether it is going to rise or whether it is going to fall. That means whether it can be 86 rupees or it can be 81 rupees. But the exporter will receive exactly the forward rate, which is 84.20 rupees per dollar. This is the power of forward rate. It eliminates uncertainty. Now let us understand what is forward rate differential. Forward rate differential can be forward premium or forward discount. Now since we know what is spot rate and forward rate, we can also talk about the relationship between them. The forward rate is almost never exactly equal to the spot rate. It is either higher or lower, and this difference is called the forward rate differential. When the forward rate of the foreign currency is higher than its spot rate, we say that the foreign currency is trading at a forward premium. It is more expensive to buy in the future than it is today. When the forward rate of the foreign currency is lower than its spot rate, we say that the foreign currency is trading at a forward discount. It is cheaper to buy in future than today. Now, we will understand depreciation and appreciation of currency. These are perhaps the two most important and most frequently used terms in the international financial management. Currency depreciation means that currency has fallen in value relative to the another currency. You now need more units of the domestic currency to buy 1 unit of the foreign currency. Now let us consider a situation in which the rupee has depreciated. Now how? First, 1 USD, that is $1, was equal to 80 rupees. But after some time, $1 becomes equal to 85 rupees. This means the rupee has depreciated. You now need more rupees, that is 85 instead of 80 to buy $1. The rupee has become weaker. Now, what is currency appreciation? It means that a currency has risen in value relative to another currency. You now need a fewer units of domestic currency to buy 1 unit of foreign currency. Now, let us fix this with a clear illustration. Let's say the rupee has appreciated, and earlier the USD rate was 80 rupees. Now the USD rate is 78 rupees. That means the rupee has appreciated. You now need fewer rupees, that is 78 rupees instead of 80 rupees to buy $1. The rupee has become stronger. Now let's talk about another important term, which is official rate and market determined rate of exchange rate. Now we have a government fixed rate, which is also known as official rate. When the government or central bank officially declares and fixes the exchange rate, it is called the official rate or official exchange rate. This is the rate that government announces and commits to maintain. It is not determined by the market forces. It is administratively set. Now, what is market determined rate? When the exchange rate is freely determined by demand and supply in the foreign exchange market without government intervention or declaration, it is called the market rate or market exchange rate. This is what we observe in the floating or managed float. Now let us understand that how market rate are determined. As we all know, demand and supply of the currency matters a lot. An exchange rate is simply a price, just like any other commodity. It is the price of one currency in terms of another. The exchange rate are either fixed or maintained by the government, or they are determined by the market dynamics. When they are determined by the market, its price is like any price in the market economy. It is determined by demand and supply. Now let us understand what creates the demand for a currency. Demand for a currency arises whenever someone needs to buy that currency. Think about all the situations in which people and institutions around the world need to buy Indian rupees. For example, a foreign company wants to invest in India. Perhaps it wants to set up a factory or buy shares in the Indian stock market. To do so, it must first buy rupees. A foreign tourist visiting India needs rupees to spend in India. A foreign government or central bank wants to hold rupees as a part of its reserve. or a foreign firm has imported Indian goods and needs to pay the Indian exporter in rupees. All of these create demand for rupees. When demand for rupees rises, its values goes up. The rupee appreciates. What creates supply of a currency? Supply of a currency arises whenever someone needs to sell the currency. Indians traveling abroad need to sell rupees and buy foreign currency. Indian companies importing goods from abroad need to sell rupees and buy dollars or euros to pay their foreign suppliers. Indian investors putting money into foreign stock markets sell rupees to buy foreign currency. All of these create supply of the rupee in the foreign exchange market. When supply of the rupee rises, more rupees are being offered for sale. Its value falls and the rupee depreciates. The equilibrium exchange rate is the rate at which the demand for a currency exactly equals its supply. In a free floating exchange rate system, where there is no intervention by the government to fix or maintain the exchange rate, the spot rate at any moment is the equilibrium rate, constantly adjusting as demand and supply shift. We have already understood that RBI intervenes in foreign exchange market to manage the rupee. Now let us organize this intervention in two clear categories. That is, if the central bank wants to manage an exchange rate, what tools does it use in order to maintain that exchange rate? The interventions are in two clear categories. The first category is the direct method and the second is the indirect method. Now let us keep it very simple. Now how central bank of the country maintains exchange rate through direct method? It is by selling and buying foreign currency. This is very simple and a visible method. The RBI directly participates in foreign exchange market as a buyer of foreign currency or a seller of foreign currency, primarily the US dollar. Let us understand it. Now let us say there is a situation in which the rupee is depreciating and the government wants to control it. It wants to stop further depreciation of the rupee. The exchange rate is moving from, let us say, 83 rupees per dollar to 86 rupees per dollar. Now people are selling rupees and buying dollars in large quantities. This shows that dollar demand is exceeding dollar supply. The RBI steps in and sell dollars from its foreign exchange reserves directly into the market. Now what happens? Dollar supply in the market increases. More dollars are now available. When anything becomes more available, its price falls. So the dollar becomes relatively cheap, meaning fewer rupees are needed per dollar. And hence what happens? The rupee recovers and it stops depreciating further. At the same time, to purchase these dollars from the RBI, market participants must pay in rupees. Those rupees come back to the RBI. Rupees supply in the market decreases. Fewer rupees in the market means each rupee becomes more valuable. So two things happen simultaneously. Dollar supply goes up and rupee supply goes down. Both push the rupee upward. The depreciation is stopped. Now let us talk about another situation in which the rupee is appreciating and RBI wants to reduce this appreciation. Now it is an opposite situation. Here what it means? Large amount of foreign money are coming into India. Foreign investors are selling dollars and buying rupees to invest in Indian market. That is why the rupee is increasing sharply, say from 83 per dollar to 79 per dollar. A very strong rupee is not always desirable. It makes Indian exports expensive for foreign buyers and hurts Indian exporters. So the RBI steps in and buys dollars from the market paying rupees. Now what happens? The RBI is absorbing excess dollars from the market. Dollar supply falls. Dollar becomes relatively scarce and therefore more valuable, meaning more rupees are needed per dollar. Simultaneously, the RBI is releasing rupees into the market as payment. Rupee supply increases. More rupees in the market means each rupee becomes slightly less valuable. Again, two things happen simultaneously. Dollar supply goes down and rupee supply goes up. Both push the rupee downward. The excessive appreciation is now checked. The direct method is immediate, visible, and powerful, but it has one limitation. The RBI's foreign exchange reserves are finite. It cannot keep selling dollars indefinitely. This is why the indirect method is equally important. In indirect method, we control the money supply. This method works from the inside by controlling how much money is circulating in the Indian economy. The RBI does not go into the forex market directly here. Instead, it uses its monetary tools to expand or contract the money supply, which then influence the exchange rate indirectly. The logic is straightforward. If there are more rupees in the economy, rupees are relatively in abundance and therefore they are less valuable, and hence the rupee will tend to weaken. But if there are fewer rupees in the economy, rupees are relatively scarce and therefore more valuable. The rupee tends to strengthen. So the RBI controls the exchange rate indirectly by controlling how many rupees are in circulation. Rupee is depreciating. RBI contracts money supply. The rupee is falling and RBI wants to strengthen it without directly selling dollars from the reserve. It uses its monetary tool to reduce the supply of rupees in economy. How does it do? By raising the repo rate, that is bank rate. The repo rate is the rate at which RBI lends money to the commercial banks. When the RBI raises these rates, borrowing becomes more expensive for banks. Banks in turn raises their lending rate. Business and individuals borrow less because the lending rates are very high. Less borrowing means less money is created and circulated in the economy. So, money supply contracts. With fewer rupees available in the economy and consequently fewer rupees flowing into the foreign exchange market, the rupee becomes relatively scarce. A scarce rupee is more valuable rupee. The exchange rate improves. Additionally, higher interest rates make India more attractive for foreign investors seeking better returns. They bring in foreign currency to invest in Indian assets. Dollar supply increases. This further supports the rupee. Another way is by raising the cash reserve ratio, that is CRR. The CRR is the portion of deposits that bank must compulsorily keep with the RBI. They cannot lend this portion out. When the RBI raises the CRR, banks have less money to lend further. Credit in the economy shrinks, money supply falls. Rupee becomes scarce and then rupee strengthens. Another way of controlling the money supply is open market operations, that is by selling government securities. When the RBI sell government bonds and treasury bills in the open market, banks and investors buy them by paying rupees to RBI. Those rupees are absorbed by the RBI. and taken out of circulation. Money supply in the economy falls, rupees become scarce. Rupee then strengthens. All of these tools work through the same channel. They reduce the amount of rupees in circulation, making each rupee more valuable, which help in reducing the depreciation of the rupee. Now let us say another situation, and in that situation the rupee is appreciating. Now RBI needs to expand money supply. Now the rupee is rising too fast and RBI wants to weaken it or to bring it down to protect the exporters. It does the exact opposite. It increases the supply of rupees in the economy. Now it reduces the repo rate. Reduction of the repo rate means bank borrow from RBI at a cheaper rate. They lend more to business and individuals because the business and individuals are also getting at a loan at a cheaper rate. And because of this, the money supply expands. Money rupees in economy means each rupee is relatively abundant. Hence, the rupee weakens slightly. Next is by cutting the CRR. Lower the cash reserve ratio means bank must keep less with the RBI and can lend more. They can give more, the credit expands and money supply increases, which means rupee weakens. By buying government securities, that is open market operations, when the RBI buys government bonds from the banks and investors, it pays them in rupees. Those rupees enter circulation, money supply expands, rupee becomes more abundant and rupee now depreciates. Next important concept is overvaluation and undervaluation of currency. A currency is said to be overvalued when its exchange rate, which is fixed by the government or central bank, is higher than what free market forces or economic fundamentals would suggest it should be. In simpler terms, the currency is being held at an artificially strong level. The government or central bank is maintaining a rate that makes the currency appear more valuable than it actually is in terms of underlying economic reality. Let us understand it with a clear example. Suppose the economic fundamentals of a country, that is its inflation rate, trade balance, productivity levels, and purchasing power, suggest that the fair value of its currency should be 100 units per US dollar. But the government officially maintains the exchange rate at 80 units per dollar, meaning the currency appears stronger than fundamentals justify. In this case, the currency is overvalued by 20 units relative to its fair value. Next comes undervaluation. A currency is said to be undervalued when its exchange rate is lower than what economic fundamentals justify. The currency is being held at an artificial weak level. It appears less valuable than it should be based on the underlying economic reality. Using the same example, if economic fundamentals suggest the fair value is 100 units per dollar, but the government maintains the rate at 120 units per dollar, meaning more domestic currency is needed per dollar. The currency is undervalued. A currency is said to be undervalued when its exchange rate is lower than what fundamentals justify. Now let us talk about hard currency and soft currency. A hard currency is a currency that is widely accepted across the world. It is fully convertible, is stable in value, and is issued by a country with a strong, credible economy and political system. Hard currencies are trusted as a store of value and a medium of exchange in international trade and finance. This currency is fairly stable. Classic example of hard currencies are the US dollar, the euro, the British pound and the Japanese yen. Of these, the US dollar is the dominant global reserve currency. Most international trade take place. Most commodities prices are set and most central banks hold their foreign exchange reserve. A soft currency is a currency that is limited in international acceptance, tends to be volatile or subject to government controls, and is typically issued by economies that are less stable or less open. Soft currencies are not widely trusted in international transactions, and counterparties in international trade may be unwilling to accept them. Due to less demand, it tends to depreciate. Many currencies of developing and emerging market economies are considered soft currencies. Now, let us understand four basic concepts. Let's move from terminologies and role of central bank to few concepts. It's like export becomes cheaper when the domestic currency depreciates. Right? Now, how does it becomes cheaper? So, let us say 1 USD as given to us is 80 rupees. Fine. That means if we go to buy $1, we will have to spend 80 rupees. Now, let us say that there is an Indian exporter. This Indian exporter is exporting, let's say, a goods, and it is selling goods at a rate of 80 rupees per unit. And it is selling how many goods? The number of goods sold are 100 units. How much USD will be paid by the US importer? US importer will pay $100 for 100 units, because each unit is equal to $1 when the price of 1 unit is equal to 80 rupees, because the exchange rate is what? Exchange rate is 1 USD equal to 80 rupees. Now, what happens when the rupee depreciates? That is, the value of rupee decreases. When it depreciates, what is given here is 1 USD equal to 85 rupees. That means if you have to buy 1 USD, you will have to spend 85 rupees. So, USD is becoming expensive. So, hence USD is appreciating while rupee is depreciating. Then how much you are going to pay? That is the question. Now, the US importer has to pay how many rupees? 80 rupees, which is the price of the product, 80 rupees into 100, which is the number of units he is buying. So, this comes out to be 88,000. So, 8,000 rupees he has to pay, but this is in rupees. How much he has to pay? How much he will pay he will pay in dollars when the exchange rate is $1 is equal to 85 rupees. So, here it is going to be 8,000 divided by 85, giving us $94.1. So, earlier he was paying $100 and now he will be paying $94.1. That means he is going to save approximately $6. So, the export has become cheaper for the US importer. While if you talk about the Indian exporter, he gets the same amount of money, 94.1 into 85, giving him almost 8,000 rupees. But for the importer, US importer, the export or the product has become cheaper. Now, here we have understood that export becomes cheaper when the domestic currency depreciates. The reverse is also true. The exports become expensive when the domestic currency appreciates. So, exports become expensive when domestic currency appreciates. Okay. Now, let us discuss another thing in which import becomes more expensive when the domestic currency depreciates. Now, how is it possible? Let us say there is an Indian importer, and he is importing what? He is importing oil. Fine. Now, there is a price of oil per barrel which is given to us is $100. Fine. Now, if suppose the 1 USD, that is $1 is equal to 80 rupees, then how much he will pay? He will pay 80 into 100, which is 8,000 rupees. So, what he will do first? With this 8,000 rupees that he has, he is going to convert it into USD and will get how much USD? 100 USD, which he is going to use for payment. Now, let us say the rupee depreciated vis-a-vis dollar and dollar became more expensive, and now $1 is equal to 85 rupees. You need 85 rupees to buy $1. Now, the importer will first buy dollar with rupees that he has. Now, here he has to buy how many dollars? He has to buy $100. And what is the new exchange rate? This is the new exchange rate. So, to buy $100, how much rupees he is going to spend? He will spend 85 rupees per dollar into 100, giving 8500. So, now he will pay 8500 instead of 80,100, that is 8,000 before. So, for importer, the import become very expensive when the domestic currency depreciates, and the reverse is also true. Now, what is the reverse case? The reverse case is that imports become cheaper when domestic currency appreciates. Now, another thing that we should discuss is that the value of a foreign currency assets gets eroded or it becomes less when the foreign currency depreciates and the domestic currency appreciates. Now, let us concentrate to the domestic currency only. Fine. Let us say that there is an Indian investor and he has bought how many shares? He has bought shares worth $10,000. So, this Indian investor has invested where? Invested in US and bought the shares. What is the share value? It is $10,000. Fine. So, these shares are actually the asset for the Indian investor. Now, when 1 USD or $1 is equal to 80 rupees, now what is the value? What is the value of asset in rupees? It is 80 into 10,000, giving us 8 lakhs. Now, the share price has gone up by 10%. That means the total value of this 8 lakh will increase by 10%. So, the value of shares is equal to $10,000 into 1.1, giving $11,000. Now, earlier when the rate was 80 rupees, he would have got 11,000 into 80, that is 8,80,000. But now the dollar is equal to 75 rupees. So, when he will convert his dollar asset into rupees, how much he will get? 11,000 into 75. So, how much he will get? 8,25,000. So, because of the depreciation in the foreign currency, or you can say appreciation of the domestic currency, the value of the investment has reduced than what he was expecting before, when the rate was 1 USD is equal to 80 rupees. Now, let us consider another scenario, and in this liability in foreign currency decreases when the foreign currency depreciates and domestic currency appreciates. Fine. Now, let us say that there is an Indian company and this Indian company borrows from US, and how much it has borrowed? It has borrowed 10 lakh dollars. Fine. Now, when the exchange rate was how much? 1 USD was equal to 83 rupees. Then what was the liability of Indian company in rupee terms? Because after all, the Indian company is receiving its earnings in rupees only, because it is doing business domestically. So, the revenue is earned in rupees. So, Indian company will first convert the rupees into dollars and then will repay to the US lender. So, here how much it will have to spend in rupees? It is 83 into 10 lakh. This gives around 8 crore 30 lakhs. Now, what happens is there is a new rate. The new rate has become 1 USD is equal to 78 rupees. Now, if the Indian company has to repay, it will convert its rupees into dollar first and then repay to US lender in dollar. So, here it has to pay how much? 10 lakh dollars multiplied with 78. So, here it is going to be around 7 crore 80 lakh rupees. So, we can see that the liability has gone down when the foreign currency is depreciating and domestic currency is appreciating. While the reverse is also true, and in the reverse case, a liability in foreign currency increases when foreign currency appreciates and the domestic currency depreciates. So, let us conclude. We introduced some basic concepts and scenarios of international financial management, including exchange rates and currency movements and central bank intervention. We also examined how exchange rate changes affect trade investments and foreign currency liabilities. Now, these are the concepts that we will also revisit in our coming lectures whenever a relevant topic will be discussed. Thank you. Bye for now.